So you guys ready for quiz 3? Well, quiz 3 is not that difficult, but I say that about every quiz, so don't believe a word I say. But quiz 3 covers two basic topics. One, of course, is multiples, and there are four sub-aspects to multiples that I'd like you to be, if not master of, at least comfortable with. One is that consistency test, which is what's in the numerator must match up to what's in the denominator. If you have no idea what I'm talking about, we talked about it very early in the process. Price-earnings ratio, numerator is a market value of equity, denominator is to be an equity number. So the consistency tests are critical in multiples. Second, we looked at distributions of multiples, all those histograms. And notice they all had that peak to the left and tail to the right. The averages were much higher than the medians. That's something that's going to come into play when you use multiples. Third is, and this is particularly important, is you need to be able to tell me what variables drive each multiple, which means you got to be able to go back to an intrinsic valuation model and back out of that model what the drivers are of PE ratio, EV to EBITDA, EV to sales. It's very simple algebra, and you don't need to do a two-stage model. If you can do a stable growth model, you're home free. And finally, there are application tweaks. When you start applying them to compare across companies, how do you control for differences? We talked about sector regressions and market regressions, but they're just tools in your toolkit. On private company valuation, three big issues. One is that the discount rate might vary depending on who the potential buyer of your company is. If that investor is not diversified, they're going to demand a much higher cost of equity. The second is cash flow adjustments, things like the owner not charging themselves a salary. How do you adjust for that? And then post-valuation, there are adjustments for, hey, what do I do about liquidity? What do I do if a key person leaves? So those issues will all come into play. So let's start with multiples. The best way to think about multiples is a numerator and a denominator. In the numerator, you can have one of three numbers. You can have the market value of equity, or market cap, price per share. You can have the market value of the firm, which is market value of equity plus market value of debt, though people cheat and use book value of debt. Or you can use enterprise value, which is market value of equity plus market value of debt. People cheat and use book value of debt minus cash. And they're all estimates of what the market is paying for either all of the equity, the entire firm, or the operating assets of the firm. So the numerator is always a market number. In the denominator, you can have revenues. Old-fashioned sales are revenues. You can have drivers of revenues, number of subscribers, number of customers, number of units. You can have earnings. To equity investors, that can be net income or earnings per share if you're doing things on a per share basis, or to the entire business, which would be operating income. You can have cash flow measures. You can just add the depreciation back to net income, which is some midpoint cash flow to equity. You can do a full-fledged free cash flow to equity. You can add the entire DA to EBIT and come up with EBITDA, or you can have free cash flow to the firm. And finally, you can have book value. You can have book value of equity, book value of debt plus equity, which would be book value of the firm, or book value of debt plus equity minus cash, which is called book value of invested capital. Which one should you use? You tell me what's in the numerator. I'll tell you what should be the denominator. As an example, if your numerator is market value of equity, your denominator needs to be just book value of equity. If you net cash out of the numerator, you need to net cash out of the denominator. If you add debt to the numerator, you've got to add debt to the denominator. It's as simple as that, and that's all the consistency test requires. So let's try it out. So spring 2009 prom, I gave you four companies, and I gave you information on the companies. I gave you the market value of equity, I gave you the debt, and you can assume it's market value of debt. I gave you the EBITDA, and I gave you the cash. But then I gave you two items that are going to throw you off. One is the market value of the minority holdings that this company has in other companies, so 10%, 5% small holdings in other companies. And the other is the market value of the minority interests in this company, which basically means that there's a consolidated company somewhere in this picture, and the minority interest is my estimate of the market value of what doesn't belong to you. So the question was a very simple one. On an EV to EBITDA basis, which of these companies is cheapest? Now let's do it actually the simplistic way. Simplistic way is just take debt plus equity minus cash. So if I take company A, debt plus equity, so market value of equity is 1,000, plus debt is 500, minus cash is 200. That gives me a $1,300 enterprise value. If I divide by EBITDA, 1,300 divided by 200, I get an enterprise value to EBITDA of 6.5. In fact, if I use that approach for all four companies, company A looks like the cheapest company. But here's where I'm screwing up when I do that. In my denominator, I have EBITDA, right? And I've got this minority holdings and minority interest floating around, and I don't know what to do with them. Here's a simple way to decide what to do. In your denominator, there's EBITDA, right? The income from the minority holdings don't show up in EBITDA. Remember, they show up below the operating income line. Because the income is not in my EBITDA, I need to subtract out the minority holdings. So for company A, I'm going to subtract out the 100 million in minority holdings from the numerator. Now, the EBITDA also reflects consolidated financials. So it reflects 100% of the consolidated subsidiary's income. So I'm going to add the minority interest to get back to 100%. Again, it's consistency. So here's what company A is going to look like. It's going to be 1,000 plus 500 minus 200 minus 100, the minority holdings, plus 400. You divide by the EBITDA. The correct EV to EBITDA is the second to last column, which is 8. And I do that for every company. The cheapest company in this group is company B. It has an EV to EBITDA of 6. So try that out when you have these consistency tests to see what's in the denominator and work back to see what should I be taking out of the numerator or what should I be adding in. Now, the second issue you're going to have to deal with are the distributional issues. And fundamentally, there were 4 points we made about the distributional characteristics of multiples. One is the distributions are asymmetric. Sounds fancy, but basically it means that your outliers all lie in one direction. They're all big positive numbers. There are no big negative numbers. Because of that, the summary statistics can be misleading. So if I ever gave you the average for a sector and a median, I want you to use a median. Absolute rules of thumb will break down. So if I say 6 times EBITDA is cheap, remember in 2009, half of all US companies traded at less than 6 times EBITDA. So we talked about using percentiles. The 20th percentile is a cheap company. Much better rule than to actually take a number like 5 or 6 or 12. And finally, remember, multiples have no currency attached to them because the currencies drop out. So I can compare PE ratios across countries, across markets, across companies. But I still have to control for differences in growth and risk and consistency. But I don't have to control for currency per se unless it shows up through inflation and interest rates. Okay? So let's take the spring 2011 problem. Not a direct test of the distributional concerns, but I thought it might be a useful problem to do nevertheless. It's a telecom company that reported an EBITDA of minus 15 million. So it's a distressed company. It's expected to have a cost of capital of 12% for the next 5 years. You're saying, why do I need a cost of capital if I'm doing a relative valuation? Well, hold on. I estimate that the firm will be a healthy telecom firm and generate 25 million in EBITDA in year 5. So by year 5, I see it becoming healthy. I tell you that healthy telecoms trade at 6 times EBITDA. Now I could have become tricky here and said the average EBITDA was 8 and the median was 6 and hoped you'd use the median, but I wasn't being tricky. So I gave you the 6 times EBITDA. And the cost of capital for those healthy telecoms today is 9%. So the question is, what is the enterprise value for telemedia today, assuming the company makes it back to health? So let me do that part first. The estimated enterprise value in 5 years is going to be the 25 million times 6, 150 million. Now there are 2 different costs of capital floating around. The 9% is for healthy companies, the 12% is for my distressed company. I've got to live through 5 years of distress to get to health. So basically I'm going to discount the 150 back, 5 years at 12%, which gives me 85.11 million as my value today. But there's one more loose end, and I'm going to go back to the previous page and tie up that loose end. Let's assume Telemedia has a 5-year zero coupon bond outstanding. Now, there's a reason I'm giving you a zero coupon bond. It makes your life a little simpler, and it's trading at 60% of face value. Risk-free rate is 3%. I ask you what the probability is that the firm will survive until year 5, because I've got to make it to year 5 to get that healthy EBITDA multiple, and what the survival adjusted enterprise value is. So here's what I do. I set up the price of the bond today, which is 60, as 100 times 1. So because it's a zero coupon bond, there's only one cash flow in 5 years. And that's why I made it a zero coupon bond. It makes the math a little easier. So it's going to be 100 adjusted for the likelihood that you're going to be around. 1 minus the probability of default, discounted back 5 years at the risk-free rate, because I've already adjusted the numerator for risk. If I solve for the probability of default, I get 30.44%. Now I'm implicitly assuming that if you default, your enterprise value is 0. Now, if I could have made this problem a little trickier and said if you default, you get a book value of 30 million or 40 million or 1/3 of your estimated enterprise value, in which case your probability adjusted value would be the present value that you got in part A plus 30.44% times the liquidation value in default. Here the liquidation value is 0. Basically, my probability adjusted value is therefore 69.56% times 85.11, which is 59.2 million. So keep that in mind as you work through these problems. Just because you're doing relative valuation doesn't mean all the lessons we kind of emphasized in discounted cash flow valuation about survival and making it through just go away. Let's talk about the determinants of multiples. The trick we used was a very simple one. We had an equity multiple. We went back to a stable growth dividend discount model, or a free cash flow to equity, stable growth free cash flow to equity model. And then we did the algebra to figure out what drove PE ratio, price to book, price to sales, etc. If it was an enterprise value multiple, we went back to an enterprise valuation model where we took free cash flow to the firm divided by cost of capital minus the growth rate. Keep that rule. Look at the multiple. If you ever have to figure out what drives a multiple, go back to an intrinsic valuation model. Keep it simple and make it a stable growth model. Because once you do that, you can see what drives every multiple. Basically, you can do the algebra and you're going to find that price earnings ratio is a function of the payout ratio, the cost of equity, and the growth rate. You do the price to book, you're going to throw in a return equity. Price to sales, you're going to see net margin. With enterprise value multiples, all that's going to happen is wherever you see cost of equity, you're going to replace with cost of capital. Wherever you see payout ratio, you're going to invest with 1 minus the reinvestment rate because you're looking at the cash flow to the collective claimants in the firm. But the principles remain the same. And there's almost one problem in every quiz where I test you on these intrinsic tests. So let's try this. Spring 2011, problem 1. I give you an all-equity funded, publicly traded firm that trades at a price-to-book ratio of 1.40 right now. So I've given you the price-to-book ratio. The firm is in stable growth, growing 3% a year, and has a cost of equity of 8%. So the first part of the question was, estimate the return on equity for this company, assuming that the firm is correctly priced at the moment. So it's a stable growth firm. I've given you the cost of equity. Price to book actually is one of the easier multiples to work with because there's a shortcut you can use. There's also a longer way we can do a payout ratio. You'll arrive at almost the same answer. You'll be off by 1 plus G, but I'll give you credit either way. But here's a simpler way with price to book. The price to book ratio is equal to the return equity minus the growth rate in the denominator, cost of equity minus the growth rate return equity minus the growth rate in the numerator, and cost of equity minus the growth rate in the denominator. So I plug in the numbers: 3% growth rate, 8% cost of equity, 1.4 price to book ratio. There's only one unknown, the return equity. When I solve for it, I get 10%. Now, if you'd done it with the 1 plus G and the payout ratio, you'd have ended up with a slightly different return equity. But as I said, now your return equity would have been 10% divided by 1.03. Basically, that 1 plus growth rate will be what throws you off. But I'll give you full credit either way. The next question, though, I tell you that the firm is planning to restructure itself. It's selling off its worst division, which accounts for half the book value, and it's buying back stock with the proceeds. So that cash leaves the company. The division accounts for 25% let me back it up. It's trying to sell off its worst performing division, which accounted for 25% of the book value and 10% of the net income. That's why it's a worst performing division. And you're getting half of the book value when you divest. So let's see what's going to happen to the price to book ratio. And to do it, I first have to compute what the return on equity for Dillon will look like once it does the restructuring. So here's what I did. I arbitrarily started off by assuming a net income of 10 and a book equity of 100. You can use net income of 1 and a book. It'll work. Whatever you do, just start with some numbers that reflect what you're going to do. So in this case, my net income is 10, my book equity is 100, right? So here's what's happening after the divestiture. My net income goes from 10 to 9 because the division I sold off accounted for 10% of the net income. My book equity is going to go from 100 to 75 because it accounted for 25% of the book value. So my new return equity is going to be 12%. So if my new price to book ratio, that's the only thing that's changing. My cost of equity stays the same, my growth stays the same, and my return equity goes up. My price to book ratio is 1.80. Now, I could have made this problem trickier by making the division you sold off have a different risk than the division you have left, in which case you'd have had to back out the new cost of equity after the division was sold off. But the process is going to stay exactly the same. So whenever you have one of these analytical problems, first look at what multiple you're working with, then use the stable growth model, and I'll give you a very simple way you can cheat. If you don't want to work with multiples, you're not comfortable working with multiples, you can always go back and do your DCF model with a stable growth dividend discount model or a free cash flow to the firm model. And once you get the value, divide by your EBITDA or net income. You'll get exactly the same answer. So either way, just remember your fundamentals and look at the drivers of multiples. And finally, you want to control for differences across companies. And there were 4 ways you can control for differences. If I give you 2 companies that are exactly alike, You can just compare the multiples in these companies. That's almost never going to happen. Second, I can give you companies that are mostly alike, and then you can try to control for differences by telling me a story. So you have two software companies. One is risky. It gets more of its revenues from one customer. You might use that as your basis for arguing why that company should trade at a lower multiple. You can try to modify the multiple. That's what we do with PEG ratios. We divide the PE by the growth to try to control for growth. Not very well, but we try it anyway. Nevertheless, when we often compare across companies with different growth rates. And finally, you can use statistical techniques. I know if you're not comfortable with statistics, you've been struggling with these regressions, but they're not a big deal. The software does the regression anyway. All you have to do is to be able to use the regression. So here's what I'm going to do. I'm going to take the spring 2012 problem 1, which kind of uses this process and work it through. So you have a multinational hotel company that generates 60% in after-tax operating income, okay, and reports depreciation of 80 million. So the taxes were 40%. The firm also reported 300 million book value of equity, 300 million book value of debt, and a cash balance of 100 million. The company has 100 million shares trading at $7 per share, and its book value of debt is equal to its market value. So the question is, what's the EV to EBITDA multiple for the hotel? And second, I've run a regression across multinational hotels, and if you trust my regression, the output looks as follows. I've given you the EV to EBITDA and 3 independent variables: the tax rate, the return on invested capital, and the debt to equity ratio. So the question is, if the firm is, if Serengeti is fairly priced relative to the sector, what's the debt to equity ratio for the firm, which I haven't given you in the problem. So let's take each part of the problem. For part A, I'm just asking for the current EV to EBITDA. So I take the market value of equity plus debt minus cash. That's my enterprise value. The EBITDA is a little tricky. I mean, it's not really tricky, because I've given you the operating income after taxes is 60 million. Because the tax rate is 40%, that means your EBIT must have been 100. Then you add back the depreciation of 80 million, you get 180 million. So you divide 900 by 180, your EV to EBITDA for this company right now is 5. Now, the second part of the problem, though, to use the regression, you first need a return on invested capital. I know I've been a little sloppy about how I've defined this back and forth in the book. The best way to do return on invested capital, unless you're told to do otherwise, is to add the book value of equity plus book value of debt minus cash, which is a 500 million. You divide the after-tax operating income by that book value, you come up with a 12% return on capital. So I plug that in. I plug in the tax rate, and I don't know the debt to equity, so I leave it as unknown. But the problem does say that the company is correctly priced. Now you might wonder, what would happen if you made a mistake in part A and it fed through into part B? Well, trust me, then I would try to give you credit for the answer that you came up with, given that part A was wrong. So if I plug the numbers in, my debt to equity ratio that will give me an EV to EBITDA with that equation is 64%. So that's the implied debt to equity ratio for the company. And I'm using a relative valuation, and I'm using a regression to control for differences across companies. So that's basically what I wanted to say about multiples. Take a look at those first 2 prompts on pretty much every quiz, and you will see this play out. It's a mix of, I might ask you to do an intrinsic PE, but then I might test you on a sector regression. So be comfortable going back and forth across both ways of thinking through multiples. Which brings me to private company valuation. And the first issue, as I said, is adjusting the discount rate. Now, the process by which we estimate the cost of debt is actually the same for private and public companies. Basically, if you don't have a rating, you take the interest coverage ratio, you get a synthetic rating. You might add an additional 2 or 3% because you have a private business. The big differences are, though, in the cost of equity and the debt ratio. On the cost of equity, with public companies, we always use a market beta, assuming that the marginal investor in the company is diversified enough to get rid of all of the remaining risk. With a private business, your cost of equity might depend upon how diversified the potential buyer of the business is. Not the seller, but the buyer. And the less diversified the buyer of the business, the more risk and the higher the cost of equity they'll demand in buying your company. On the debt ratio, with public companies, we always use a market debt. With the private company, we don't have a market debt or a market equity, so we might cheat and use an industry average or a target debt ratio, or we might even do it, iteration. Though there's no way I can ask you to do that on a quiz. You don't have enough time to iterate. But I might give you the industry average debt ratio and make you use it. Now, in terms of the beta continuum, here's the way I think about what the beta I should use in a private business is. It all depends upon the potential buyer. So whenever you look at a problem relating to a private business, Always look to see what the end game here is. What are you doing the valuation for? Who are you doing the valuation for? Who's the potential buyer? If it's a diversified buyer, which is going to be the case if a public company is the potential buyer or an IPO, because the potential investor there can be diversified, chooses not to, that's their problem. So it could be a diversified buyer. It could be an investor who's completely undiversified. So the buyer is going to put all of her wealth into this business, completely undiversified. Or I could give you something in the middle, a venture capitalist or private equity investor who's partly diversified. If you're completely diversified buyer, then the valuation looks just like a public company valuation. I use a market beta, usually from looking at publicly traded companies in the space. If the buyer is completely undiversified, then I'm going to scale the market beta up by bringing in the correlation of the typical firm in this business to the market. Essentially what I'm doing is I'm bringing the rest of the risk in the company and coming up with a much higher beta. If you're partially diversified, here's the way I'm going to adjust the beta. I'm going to start with the market beta, but I'm going to divide by the correlation of your portfolio, you being the VC or the private equity investor, with the market. So the more diversified you get, the closer to one that number might become. So what I use as my cost of equity is very much a function of who the potential buyer is. As for the debt to equity, as I said, I might use an industry average, a target debt ratio, or an iterated debt ratio. But whatever I use, I've got to be consistent. In what sense? To lever the beta, I have to use that debt ratio. And then when I do the cost of capital, I have to use exactly the same debt ratio. Now, the cash flow, there are 5 basic questions I always ask myself when I try to value private business to make sure that I'm not missing something. First, if the owner is involved in the business, he's running the business, he's the accountant, he's a manager, is he charging himself a salary? Because if he's not, I have to bring that expense in, because if I buy the business from him, well, somebody's got to do that work, right? Second, I have to check to see if there are any ghost or personal expenses, because many private businesses, if they're fully owned by the owner, you might have people on the payroll who are not really working, who might be relatives of the owner, whatever it is. Are there any personal expenses intermingled with the business expenses? Third, and this is kind of a tricky, I know it's a sensitive question. Are your reporting books and your tax books the same? The reason an owner who's trying to sell you a business might be willing to give you the information is usually the reporting books will report a lower income than the tax books. So if the owner wants to get a higher value, he might pull you aside and say, are you sure you're not from the IRS? And if you're not from the IRS, he might say, let me show you the actual income I made in this business. Fourth, is there a key person discount? After you buy this business, the owner leaves, are you going to lose 20%, 30%, 50% of your revenues? And finally, is there a possibility of a tax rate shift? So if you're a corporation buying from a private buyer, is the tax rate you're going to have on the income going to be different after the acquisition than it was before the acquisition? Because if it is, you have to use your tax rate. So let's take an example. This is spring 2012, prompt 3. You're the CEO of a publicly traded company. And I've given you a firm. It's all equity funded. It has a beta 1.20. And I give you the correlation of the stock with the market. You're saying, why? It's a public company. Who cares? Here's why you should care. It's expected to generate net income of 60 million next year. Whenever you see the word next year, I'm trying to save you the trouble of putting the 1 plus G in the numerator. It's a stable growth company that expects to grow 3% a year in perpetuity. So it's a public company, it's stable growth, growing 3% a year, and I've given you the net income and the book equity. You feel as a CEO that if you invest the rest of your personal wealth, and the key word is the rest of your personal wealth. So what am I telling you? I'm telling you that you're going to be completely undiversified. If you buy this company and you take the company back to being a private business, you could double the net income. Don't ask me why you weren't doing this right now as a CEO, but you can double the net income without changing the book equity or the growth rate. Assume you plan to keep the business as a privately owned business in perpetuity. Will the transaction make sense? So let's see how we'd work this out. First, let's value it as a public company. I've given you the market beta so I can get a cost of equity. The current return on equity is 60 divided by 100, which is 6%. With a growth rate of 3%, that means I'll have to reinvest 50% of my income back. My value of equity then will be the 60 million net of the 30, which is the reinvestment, 30 divided by cost of equity minus the growth rate. Value of equity that I get as a public company is 416.67. Here's what's going to happen when I become a private business. First, I'm completely undiversified, right? So if you go back to the previous page, the market beta is 1.2 or the correlation is 0.40. So the the total beta is going to be 3. With a risk-free rate of 3% and a risk premium of 6%, that's going to give you a cost of equity of 21%, much higher cost of equity. But as a bonus, you do get higher net income. Your net income is going to go from 6% to 12%. That's going to have a double effect. Not only is your base higher, but because your return on equity is 12% rather than 6%, you have to reinvest less money. Only 25% is to get reinvested. So if I take the 120 net of the 25% and I put the 3% growth in with the 21% cost of equity, the value that I get for the equity is 500 million. So here's what I want you to do with all the private company valuations. Before you put pen on paper, look to see what details you're given on the information, but more critically, who are you doing the valuation for? Who's the potential buyer? Is the investor diversified? Because that's going to tell you what cost of equity and cost of capital to use in your valuation. That's pretty much it. So I hope you get a chance to work through this review, and I will see you at the quiz. Thank you for listening.